Hi guys, good morning. This is a continuation of of our lectures. This will be the end of this chapter, and I will also go on to do the next chapter. So I'll record this chapter and finish it off first. So we are on section 12, exchange rates and price variances. And from the earlier chapter, I talked a lot about how standards shift and standards can change due to external reasons, reasons outside our power, or if you like, not due to our negotiation, just due to external circumstances. And we want to take those into consideration before we now compare with what actually happened, if you like. So we want to clearly separate uncontrollable variances from the controllable ones, which is why we would clearly, first of all, try and isolate those. And one we looked at yesterday was inflation. This one, the one we're looking at today now, is looking at um, exchange rates when you have exchange rate variances and when exchange rates affect the price of our currencies. Let's see what's going on here. So, um, for example, introduction. Material price variances are sometimes caused by movements of exchange rates of a currency when the material is imported from an overseas country. So, if you're buying goods from abroad, those goods, for example, could be $100, and you would exchange your currency, turn your currency into the currency of the country you're trying to buy the goods in, buy that, and then bring the goods home. Now, depending on, of course, the exchange rate is and how much of that foreign currency you can get for your currency, those movements can affect how much of the foreign currency you will get. So, for example, a product in the US was worth £1, and was worth $1, forgive me. For every pound you have in the UK, you can get, if, for example, the exchange rate was $1.50, you can get $1.50 for every pound you have, which technically means that if you wanted to buy something that was worth that was worth $1 in the US, that would be the equivalent of having 67p. So 67p, of course, could get you, if you like, a dollar, or a product, which is a dollar. I mean, a dollar can be commodity as well. If you like, a currency can be considered to be commodity somewhat. Now, the same principle applies here. If you notice here, now suddenly you can get a pound for whatever reason. There is a demand for the pound. That's sort of when I say there's a demand for the pound, your pound is stronger. So your pound now can get you $2. And if your pound can get you $2, it means that you need less of your pound, even less of your pound, to get a product that is worth $1. And so these changes have nothing to do with how efficient. So, for example, if someone goes out there and because the currency has moved in favor, he gets it. He comes back to you and he tells you he got it cheaper. Well, that's not really true because he's saying, "Well, I used less pounds to get it." You say, "Well, actually, the fact that you used less pounds to get the product has nothing to do with your ability. It was purely due to fortune that the exchange rates had moved in your favor." So what are we saying here? Let's look at a question and look at this example here. And let me just snippet this out. I will come back to how they explain it, but try and sort of, express it a little, and turn that up. Okay, great stuff. So, you can see here that we have, it says you have delimited, and it says here that delimited buys 2,000 kilograms of material in March 2005. So delimited actually goes out there and actually buys, if you like, 2,000 pounds worth of, of material. Now, the question is also telling us that you buy these products from the US. So you bought 2,000 kilograms, and this is what you actually spent. So you actually spent £2,000. I'm not quite interested in this just yet. I'm interested in what you should have spent, you see, because it's all about standards, right? This is the issue here. Now, if you were to go out there and buy 2,000 kilograms of product, and it tells us here that we expect you to spend £1.05 on this product. Now, the fundamental question here is the reason why we've set it at this amount is because, if you like, you're buying this from abroad, from the US, and a pound gets you £1.50, so that's a nice $1.50. A pound gets you $1.50. right? It means that this product costs in the US 2,000 kilograms times £1.05 times £1.50, because £1 will get you $1.50, and that you have here is um, $3,150. That's the case, $3,150. So that's how much, um, if you like, these 2,000 kilograms should cost in dollars. That's how much it should cost, and that's what it costs. Now, I'll just change my pen color here. So currently, 2,000 kilograms at, if you like, £1.05 at the exchange rate gives you this. Now, the exchange rate, if you like, here now says here that it's changed. And actually, what happened was when you actually bought the goods, a pound could actually get you more, if you like. So actually, I guess another way, just before I carry on with that, I suppose that I should just sort of find what the equivalent, how much you should actually have spent in pounds. So that would have been £2,000, sorry, 2,000 kilograms times £1.05, which was 2,100. So you should have spent 2,100 on this product. So 2,100 pounds would have given you, if you like, 3,150 dollars. Okay, no problem. Now, the point here is that you can actually get this product now, because you can see here it says the exchange rate has moved in your favor. So the question here is that $3,150, if you like, is the equivalent of, if I divide that by 1.65, $3,150 is the equivalent of 1,909 pounds now, because the exchange rate has moved in your favor. So in effect, I need less pounds to buy this product that is worth $3,150. I don't need 2,100 anymore. That's the first point that I really want to stress. And I think just having an understanding of what happens when we buy products from abroad, the product itself abroad hasn't changed. Or the value of the product abroad hasn't changed. It's just the exchange rate that has changed, meaning you will need more or less of that, of your home currency, to buy that product. So the product is still 3,150, hasn't changed. We just need less pounds to buy it. So you turn up saying, "Hey guys, I was supposed to spend 2,100. I spent £2,000 buying this product. Hey, that's a favorable variance because I spent less." And we sort of say to you, "Well, actually, not the case." First of all, what we have here is that what's really happened is that we start off with 2,100. That is the original standard. That standard now falls to 1,909. So we now have a favorable variance, operational, if you like, in effect, sort of saying that, listen, we've actually had, so you want to tell us that, listen, guys, I actually have a £100 favorable variance here. I spent less. We're like, no, no, no. What really happened was you actually had, first of all, a 2,100 minus 1,909 favorable variance of 191. So this was a planning variance. It was an economic variance, nothing due to you. It is favorable, 191, favorable, um, if you like. So you should have bought these goods for 1,909. But you go along, unfortunately, and you end up spending £2,000, which is, if you like, unfavorable. So you end up spending £91 more than we would have expected you to spend, which is why, of course, it is overall 100 favorable, because it is 191 favorable plus 91 adverse, right? Because that's what's happened here. Because you spent 2,000, you should have spent 1,909, because the exchange rate has moved in your favor, if you like, and you are spending less pounds to buy that product. So I think that, I think understanding what's going on is critical to highlight. I think the most important thing to understand is that the dollar price of this product does not change, and that could be a reference point for you to always find out what the home new standard would be, and then take action in deciding for yourself whether or not there has been an advantage or not. So let me just go back to the main page and see how they sort of tackle it here. And so the key point here is they're highlighting here that the person responsible for buying the material may feel that they should be given credit for the 100 favorable variance, but no. Let's separate out what we see here: a price variance caused by the exchange rate, sometimes referred to as a planning variance. Yeah, so as I've called the planning variance, outside your control, and what we would call an operating variance, where you have some control over this. So we, like you see here, this is what I've done in effect. That's the 2,100. We had to find this 1,900. They haven't quite shown you how they found it, but it's the same sort of principle, 2,000, and basically find the change in the exchange rate by multiplying that by £1.50 over £1.65, or go through the process that you saw me go through, so you actually know how you arrive at this number. And then this is the actual cost, and then you can see you have a favorable variance in the end. So there we are. Total variance is 100 favorable, but of course that's made up of 191 favorable and 91 adverse. Cool, great stuff. So yeah, and we'll carry on. I'll just pause just to set that up for the next part. Okay, let's carry on. So so TYU3, let's walk through that. And I think it's, again, like I said, it's the reason why I wanted to make these videos was to at least try and do a few TYUs. The time in the class doesn't really allow for that. They do take some time. But let's walk through this. Hopefully read it first and then see where it's going, if you like, so you can understand what's happening. Okay, so it says here that Rivermead Limited makes a single product called Faster, and last year Steve Jones, the MD of Rivermead, attended a course on budgetary control. As a result, he agreed to revise the way budgets are prepped in the company. So rather than imposing targets, he encouraged participation by senior managers in the preparation of budgets. So he prepared an initial budget, but Mike Fisher, the sales director, felt that the budgeted sales volume was too high. So he had gone along and he had actually prepared this budget here with 24,000 units to sell, but Fisher felt that was too high, so they revised it down to 20,000. And Fisher explained that setting a very high budgeted sales vol would mean the staff would be demotivated because they wouldn't be able to achieve that volume, and therefore he agreed to use the revised situation. So what you now have is an original budget and of course a revised budget down. So in a way, it almost feels a bit like a it's not a flexible budget, but you can see that you can sort of, they've given you both sets with the information there, which would be relevant because, of course, this is all variable and semi-variable and fixed. And then we actually have the results, and then the variances from the revised budget. Now, what we see is this information, so you can just flick through, and it is what you expect, that a fall in volume would lead to a fall in material and labor, as with heat and lighting. And then, of course, you can see the actual results are higher because this is 22,000 units. So we know that in the end, there must be some. So what you can see, they've done this sort of thing where they've done a variance. This is irrelevant, of course, technically, because he is comparing the situation of 22,000 units with that of 20,000 units. So we know this, as part of this exercise, at some point we are going to have to flex the budget. We're going to have to flex the budget to get it there. So it says that assume no changes to the input prices, no changes to the quantity of variable inputs. And then it tells us there's some other issues. It says that as the management accountant at Rivermead, one of your tasks is to check the invoices have been properly coded. on checking the invoices for heat and light, you find out that there's an invoice of 7,500 that's been incorrectly coded, and this should have been put to materials. So here in this figure here, I need to take out 7,520, and I need to add that to materials, 7,520. So what I'm going to really do very quickly is just create an Excel spreadsheet very quickly and plug these figures in very, very quickly, so we can just walk through that slowly and see where we're going here. And so what we have here is we have this original budget, and we have the revised budget, and then we have the actual results. Okay, right, brilliant. And then of course we have here materials, labor, heat, light and power. And then we have here rent, rates, and depreciation. Okay, great. So let's look at that. And we have here, of course, it starts off with so the units, of course, here 24,000, 20,000, 22,000. That's fine. So you can kind of, whoop, that's 20,000. You have this sort of, make this, you have there. Yeah, you have that coming in through there. And then what you then have, of course, I'll just give some sort of space in there. Material 216,000, whoops, 000, 180, 000, 206, 800. And of course here you have 255, 200, 240, and you have 288, 000. Right, and then here for heat and light you have 31, then you have 27, and then here you have 33,400, 33,400. And then for rent you have 40, then here you have 40 again, and then here for actual you have 38. Okay, right. So, and this is what we have. So the first issue that we had there was that 7,520, and the question tells us clearly that this is too high, so we need to take off 7,520, 7,520, take that off, and I'm going to add on, the question is telling you that you've miscoded, and again, you need to add on 7,520 to that bit over there. That's the first thing that we're going to do. So you can see those adjustments there. The first set of adjustments. So it then says to us, if we go to the question then says to us that what they want us to do is to use the information and identify, using the original and revised budgets, find the variable cost of material and labor. So that's quite nice. We know that these are variable, so we know here to a certain extent that variable costs are the same with every unit. And so if materials for making 24,000 units is 216 as a whole, you will accept that the cost per unit must be that divided by the 24,000 units, and that's £9. So we can see that that's £9. That's the variable cost of materials. It's £9. We can test it again, of course, I guess just by dragging the formula across. That should be £9 as well. So we do exactly the same thing. Variable cost of labor. Again, literally, I just want to see if 288 is used to produce 24,000. We can find the variable cost of labor Yes, and that's what we have. So what is the variable cost of labor again? That would be that divided this divided by the original budget of 24,000. That's 12. And then what do? I can test that again, just drag that across, and that should be 12 as well. So I've now found those variable costs, if you like, of those. I'm told in the question this is a semi-variable cost. So let's just go back to the question, and we have satisfied task one. It says find the fixed and unit variable cost within heat and power. So within heat, oh, sorry, yes, because, well, this is fixed, of course, because this is rent rates. And then heat, light and power. Remember that this is, now it's semi-variable, so you have to use the high-low method. The high-low method. And again, here we are looking at two levels of 20,000 and 24,000. I'm sure again, like you're all getting happier with the high-low method. If I was to draw something of a graph here, I would have here 20,000 units, 24,000 units, and the total cost here at 20,000 units is 27,000. And the total cost here is 31,000. And therefore, the high-low method tells you to do that exactly. And then you have 4,000 over 4,000, which gives you a pound. So the variable cost per unit is £1. So now that I know that, all I need to do is go back into one of them, of course, and plug in. So if I have a total cost of 27,000, I know that my fixed costs plus my pound times the 20,000 units, right? And therefore, if my fixed cost is 20,000, if my variable cost is 20,000, my variable cost is 7. You can test that, but I'm going to trust that. So that's my fixed cost. So the question is asking for the fixed and the unit variable cost. So the fixed cost is 7,000, and the variable cost is a pound. So those are the numerical questions that you will see. This is a classic question. It's not a bad question. A classic, you can get this kind of thing, and you could be asked to play around with that. Then the question then goes on to do a bit of talking. And like I said before, this is important. It says that briefly explain why the flex budget variances differ from those in the original statement. Well, then the question says prepare flex budget. So we actually have to prepare a flex budget. So let's prepare the flex budget. So the flex budget is, of course, at the 22,000. So I will just insert and just create and just write here flexed, right? Flex budget, of course. And that's at 22,000. So you, again, the materials there, you have that. We know that the cost of each of these is 9. We're just really multiplying 9 by the 22,000, what we would have expected there. I know this is going to be at 12 because that's what we've been talking about. 12, multiply that by that. And then now I know that I have a fixed cost of 7,000 plus £1 times, if you like, my total number of units. And then I should have that. Fixed costs remain the same, and you're there. And this is your flex budget. I'll just give it a different color, maybe. And that's your flex budget. So of course the variances, of course, will be different. So I can have variances now due to that, and you can just find those. The question just says, the question is asking, I mean, you can find what these variances are, but the question goes on. We'll go to the answers anyway. But the question does say that explain why the flex budget will differ from the original. Well, because the flex budget is at the using 22,000 units as opposed to using the revised version of 20,000. So the flex budget is a more meaningful budget because it is based on the actual activity, so we can actually assess what the client should have done at those values. That's the first thing. And then it goes on to say give 2 reasons why favorable cost variance. Why favorable cost variance, so why we have been able to save money, if you like, on the cost of the raw materials or of and labor may have arisen other than through the introduction of participative budgeting. And we went through a list, a really long list of reasons why you can have a favorable cost variance, um, from getting in better relationships with suppliers, getting discounts, um, having more motivated staff. You have a number of things, but let's just go and see what what answers they are putting down. But I don't want you to be restricted by that. You can be as creative as you want to be, but as long as you're aware that we're talking about trying to look for reasons behind a favorable um, a cost variance. So just looking at this, so for again, like I said here, the original operating compared 22,000 units with a revised forecast of 20,000. This is not a like-for-like comparison. The flexible budget, however, informs on a like with like comparison because we are looking, if you like, at activity based on the 22,000 units. 22,000 units. And if you like, this is a more like for like situation. Then, of course, it says here that there are a number of reasons why, like I said here, um, favorable cost variance. Just point really here is that things could have been better. So outside your control, we've seen examples of inflation, you might exchange rates, um, just an excess supply of the raw materials. So um, they actually do a bit of analysis on the actual breakdown of what's going on here. So the variance on the fixed expenditure relates to rent, which are not controllable. So maybe you got a new deal because you actually paid 38 instead of 40, um, because that's still the fixed cost of 40. Um, it is possible, of course, that managers, this might actually just be the budget looks worse than it really is because you can see there's an issue here, and therefore what's actually happening is less, so it looks favorable. So really, standards are important because let's not forget that standards are internal to the organization. Yes, so that's the other thing here. And then the next question says, give two reasons why the actual sales volume compared may not be a measure of improved motivation following the introduction of participative budgeting. So participative budgeting seems to be the sort of the idea that we allow these people to talk, but there are actually a number of things here. I think the key one for me is this one here, that just because Mike Fisher says you should bring it down to 20,000 and you're selling at 22 doesn't mean you actually did better. The question here is, why is Mike so sensitive about just leaving it at 24? What's the problem? So maybe 20 was actually a much lower forecast. This is not a very good forecast anyway. Um, if you like, or there might have been a genuine concern, but it may have been intentional. So, looking at things this way, it makes you look better. But the question here is, this revised budget of 20,000 is suspicious anyway. Um, and this is a whole year, so maybe you could have adjusted the revised budget as you got closer to the end of the year to get something much more real, much more closer to actual. And there just could simply have been an increase in demand, just simply a sudden desire for your product, which again would be external to yourself. Right, great stuff. And that is TYU 3. Please definitely do TYU 4. Do all the TYUs. They're good practice. It's not about perfecting them. It's about making sure you're seeing the experience and getting the experience of that. And we will carry on in the next topic. Okay, let's carry on um, with this. The last section here on backward variances, and that's on page 212. 212. And again, I've always insisted that an understanding of variances means that or understanding of the material means that you are more comfortable with what they're really talking about. It's not new, but it's you understanding what's going on, so you can always go backwards or forwards if you like. But that takes a little time, but you will see what I mean. So let's talk about some backward variances. So the examiner can give you questions that sort of look at things from going back from, it could go either way, really. So let's see what that means. Here you have, it says that A Limited buys 1,000 kilograms, and this is what it actually spends. It spends 550 pounds. So this is what they actually spend, right? And it says that they spent 50 pounds too much. So there's a price difference. So they spent 50 pounds too much. So they should have spent, right? I suppose that's the question, right? If I asked you what should they have spent, you would say to me, Loyan, they should have spent 500 pounds. And if they should have spent 500 pounds, based on that, the standard cost of 1 kilogram would have been 500 divided by 1,000, right? Because that's how we would do it. So really, that's kind of what I mean by understanding. In of itself, it's not difficult, but you can. I think by this stage now, you want to be trying to understand and see and sort of see where we're going here. I mean, again, you could use my graphs. You don't need to. This is too extreme. That's the 1,000 kilograms that are bought. They've spent. It says at a cost of 550. So you can. I know that the difference between what was actually spent and, um, if you like, what you should have spent times the kilograms is 50 pounds. I can find out what you actually did spend per kilogram because I could divide the 550 by the 1,000. I don't need to, but the point is that you could see it in different ways. It's the same point. You can go back to first principles and then sort of see that. But this, I think, is a nice, simple way because it really shows understanding because you just understand that you spent more than you should have. The same thing applies here somewhat, where it says here that it says B buys 200 liters of oil, which should have cost £1 per liter. Oh, that's wonderful. Okay. So in a way, you buy 200 liters, it should cost £1. Then you go out and it says that there's an adverse material price variance. So you spend 10p more than you should have. So you must have spent £1.10, right? That's what that is on the liters. So I take it. I mean, I suppose you can see straight away that this is what's adverse, and so therefore that's 10p on 200, which is 20. Therefore, or if someone asks you how much did you spend, well, you spent £1.10 times 200, which is 220. So you can also work that out there and sort of see it. But I think this understanding by now is what I'm looking for, which should get you there. And let's talk about an added complication, but I think it's more about reading the question carefully because you're talking about buying in products. So it says here that you have whether you could have a change in inventory. So it says the C Limited produces 600 widgets, and the material to buy these widgets, if you like, you need 3 kilograms at £2 each. So the standard cost per unit is £6 per £6 per unit. So it says there's no usage variance, so they want you to focus on price. There was no opening inventory, but you bought enough to make sure you had closing inventory of 200 kilograms. So you didn't have any opening inventory. So if you made, it says here, if you made 600 widgets and you need 3 kilograms for each widget, you must have bought in for production at least 1,800. And if you didn't have any opening inventory, but then you had closing inventory of 200, you must have bought in another 200, of course. That means you must have bought in 2,000 kilograms. So the question says here that you have a price variance, adverse variance of 200, which means that you should have spent 2,000 times £2, which is 4,000. But you ended up spending, right, 4,000 plus 200, which is 4,200. You ended up spending 4,200 because it's adverse. So the backward variances kind of sum the thinking behind variances in this sort of area because you understand where things are coming from and you can kind of work your way around. And in fact, that is the end of the chapter. Um, so please, yes, now it is a case of looking at questions, and I will be doing them as we go along throughout this week. Awesome. And I'll now be moving on to chapter 9.